All right, in this lesson we're going to talk about why auditing. So in the previous lessons we've talked about, what is auditing. Now we're going to talk about why do we really need auditing and what's the basis for that auditing. And we alluded to some of this in the last lesson about what auditing is. Okay, so why auditing? Let's think back to kind of before today, and there are a lot of businesses that we would claim that are a small business, but before we really had big businesses, what did we have? Well, we typically had an owner who may or may not have employees, but at the end of the day, the books were still done by the owner, and the owner owned the company, which means they didn't have to worry about the books being wrong because they were their own books, okay? And they were doing it, and they knew everything about their company and what was going on, okay? And that's small business, okay? Now, in today's world, we have something called big business, and the discussion that we might have is why do we have big businesses and why do we have big corporations? And it really came down to innovation, and it came down to wanting to grow their business and do more with their business, okay? And so, why big business? Well, businesses were becoming bigger because they wanted to innovate. And in order to innovate, they need more money. So if you're a small mom and pop shop, and you're running a small business, you might not actually have all the capital you need in order to expand. And so therefore you were kind of limited to your small little business and doing the things that you were always doing. So in order to expand, in order to get into more markets, in order to grow, you needed more capital. So, bigger businesses or businesses wanted to become bigger, they needed more capital in order to innovate and expand. Okay, so how did they do that? Well, businesses started this idea of selling shares of their company or selling shares of their ownership. And so companies, these small companies, in order to expand because they had a great idea, decided to sell shares in exchange for ownership. So I will give you 1% of my business if you buy, let's say, 100 shares of my company at $100 a share. Okay? And so they would sell shares, or they would issue small loans to the public. And when we mean small loans is they would issue debt to the public, and then the public would buy their debt, and the company would pay them an interest rate assuming that debt. Okay? And so because of that, we no longer have this relationship of the owner who's doing the books, had few employees or a little bit of employees, and they knew what was going on. We had this idea of a large company. Okay? And this large company had shareholders, which were those people that bought shares in the company in exchange for ownership. But when, let's say, I buy shares in a company, I'm not going to run the company necessarily. Okay? Just like if I was diagnosing someone for medical reasons, because I don't have a medical degree, I wouldn't be the right person to be diagnosing someone with a medical condition. Same goes for here. I might be a shareholder, which means I want ownership in the company, but I don't want to have to manage it because I don't have management expertise in that. And so what happened was, as we grew these big companies, shareholders, or what we would call principals, would hire management. In this case, professional managers, also called agents. So they're agents for the shareholders. Okay? And so if we think about some of our big companies, we might have Disney, whose president and CEO is Bob Iger, and he is a professional manager. Now, he also isn't a shareholder, but he doesn't own all of the Walt Disney Company. Okay? And so the board of directors or members that are shareholders have hired him to manage Walt Disney Company. Okay? And so that's management. So shareholders will hire managers or professional managers to manage the company for them. Again, making sure that we understand that sometimes these managers also are also shareholders, but typically they're not the biggest shareholders. Okay? And so shareholders will hire managers or professional managers and management, and then management will then hire staff and employees to run the company. Now, with this situation going on, who is preparing the books and the financial statements of the company? Well, it's definitely not the shareholders, especially if they don't have the expertise and they're not running the business. So if they're not running the business, who is doing the books? Well, who's doing the books are these professional managers and these staff and employees, okay? So we've got these people that are doing the books. Now, managers would like to have the best interests of the shareholders in mind. That's how they keep their jobs. But sometimes greed gets in the way. And so what we have here is something called information asymmetry. Now, information asymmetry tells us this. Let's break it down to, let's say you're buying a car, a used car. If I'm selling you my used car to you, I'm going to have more information on what's good about the car and what's bad of the car than you do. I might not tell you that the engine is not working so well. I'm just going to say, oh yeah, here's a car that I'm willing to sell you. It's $5,000. It runs really good. I'm obviously going to know more about that car. I'm going to know that the engine doesn't work. Maybe some of the sealant on the doors are coming off. The paint's getting scratched. There's stains that you can't see in the seats. Whatever. I'm going to know more defects about that car than you do, and I might withhold some of that information so that I can get you to buy that car. That's information asymmetry. I have more information, or the seller has more information than you do. Okay? Now, management is obviously going to have more information than the shareholders in terms of how things are ran, how much money they're making, what their trade secrets are. Okay. Now, there are some information that we don't give the shareholders. Like, for instance, we don't give the shareholders the trade secret on how Coca-Cola is made or what it's made out of. Okay. We just don't do that. Okay. So there's always going to be this information asymmetry of management's going to know something, but the shareholders are not. The problem with that is that that causes a conflict of interest, right? So, management may have a bonus coming to them if they can raise their revenues. Well, management's going to find any way to raise that revenues in order to get their bonus. Okay. Now, what shareholders don't know is how they're doing that, and it may or may not be ethical. Okay, so we have a conflict of interest because management wants it one way, shareholders wants it another way, and there's really no middleman here to make it an even playing field. And so shareholders want that accountability from management, so accountability from management, and the way that we get some accountability from management is the financial statements, and the way that we can trust the financial statement is through an audit. Okay? So we've got this conflict of interest, we've got management on one side, we've got shareholders on the other side, and here comes the auditors right in the middle of that to hopefully help secure those financial statements as appropriate in nature. Okay? So that auditor will come in, and we can even say right here, auditor will come in here and kind of be a bit like a liaison when it comes to financial information from management and shareholders. Okay? Management makes an assertion or a claim about something on their financial statement. Auditors review that. The auditors say, yes, it's appropriate in nature. Okay? And then that information will go to the shareholders in the form of a financial statement or an issued financial statement. The shareholders are then given a little bit of comfort that the information provided by management is appropriate in nature, okay, and not falsified. Okay? Now, does auditors give complete assurance? No, they don't give complete assurance. And we'll talk more about that later, but they don't give complete assurance because cost outweighs the benefit. Okay? So we give reasonable assurance to the investors that the financial statements are appropriate in nature based on the assumptions management puts in those financial statements. So again, why auditing? Well, the reason why we do auditing is because shareholders have to hire professional managers. Those professional managers are going to have something called information asymmetry. They're going to know more than the shareholders. They may withhold information or they may inflate numbers in order to get what they want, their personal interest, which causes a conflict of interest. And that conflict of interest then doesn't allow shareholders to have good accountability of management, and therefore we have auditors who will do an audit in order to reasonably say that the financial statements are appropriate in nature based on the audit tests that the auditors do on management's assertion in the financial statement.